Good morning. My name is Aditya Patnaik. I am an investment advisor at Sprott. The following excerpts are from a discussion I recorded with Rick Rule on the 16th of Jan 2025. We focus on the risks and opportunities in the precious metals sector today. Please contact me via email should you wish to discuss any of the topics covered in this call in more detail. If you look back at the two prior gold bull markets in the 1970s and the 2000s, and you look at their dimension, there is certainly a case to be made that the price of gold today still has a lot of room to run. Investor positioning in gold is still quite low or almost absent in a sense compared to other asset classes. Over the last 4 years now, we've seen outflows from ETFs. And I sent you a chart of the price of gold from 1970 to today on an inflation-adjusted basis. Gold is a very cyclical commodity, even though it's a precious metal. And today we are close to all-time nominal highs on that price chart. I was interested in your thoughts on where you think we are in this precious metals bull cycle today, based on the price of gold, but also based on the lack of interest in this asset class so far.
Let's work them backwards. The lack of interest is appealing to me. Buffett has famously said, buy straw hats in winter. And it certainly isn't spring, even for gold yet. The point that you make, at least over the last 4 years where I studied it, is that net investor flows, at least measured by investor participations in publicly quoted ETFs, has been negative. In fact, periodically, it has only been positive for 9 months out of the trailing 48, according to the statistics available to me. So gold has not been able to catch a bid from retail investors, at least retail investors in the West. Chinese retail investors, yes, and central banks, yes. But in terms of retail positioning in gold, the best I can tell, it's negative. And I'm fine with that. I've learned a lot about investor behavior in 50 years in financial markets. Investors are very bad at anticipating the outcome of arithmetic and positioning themselves in a sector before the narrative is justified by price. Once the narrative has been justified by price, very often the benefit of the narrative has already been lost. So the fact that gold is out of favor strikes me as a positive rather than a negative, because I'm an investor. I'm not a trader. With regards to the chart that you sent me, I have one, I think, very telling comment. When you say inflation adjusted basis, the adjuster that you're talking about, the denominator, is the CPI. And I think that's an absolutely silly measure. If you believe in the CPI stated rate of inflation, you would suggest today that core inflation is 2.6%, full inflation is 2.9%. And I think that's a silly number. I think if anybody listening to this call simply applies common sense to their own budget in the period, say, 2020 to 2025, and they ask themselves what's happened to the core components of their own cost of living, say gasoline, say heating energy, say health insurance, say health care, say rent, say mortgage payments, say groceries, now a political issue, and in particular, all of their levels of tax. If you measure inflation in the way that inflation was measured in the 1970s, according to John Williams at ShadowStats, today's real rate of inflation is over 12%. My own internal calculations are much more conservative, albeit much less studied than Mr. Williams. I suggest that for the basket of goods and services that I consume, I'm not suggesting that taxes are either good or a service, but that's a different question. If you look at the basket of goods and services that I consume, it would appear to me that the deterioration in the value of the US dollar, which is a different way of saying my definition of inflation, is proceeding along at 7.5% or 8%. And so if you adjust that chart, which itself purports to be inflation adjusted, what you will see is that gold is an awfully long way from its real all-time highs. I would suggest to you, too, that the charts are, at least in some fashion, by design, backward looking. And I think the consequence of that is that the chart doesn't take into account and isn't designed to take into account the fact that, as an example, the on balance sheet liabilities of the federal government, which were at the commencement of that chart about 35% of GDP, are now at 120% of GDP. I would also point out that that chart doesn't take into account the net present value of off balance sheet liabilities, military pensions, medical pensions, Medicare, Medicaid, Social Security, which I suspect at the time of the publication of that chart would have been at 30 or 40 or 50% of GDP, and now at $130 trillion are at 400% of GDP. So while I understand the value of backward-looking charts as a measure of relative valuation and as a measure of investor sentiment, I don't think that they are a realistic representation of the value of the asset class, given that the underlying conditions have changed radically in the 50 years under consideration by that chart.
It's interesting that gold is moving up today along with risk assets. It's moving up along with interest rates and it's moving up along with the US dollar. When you look at all of these things happening at the same time, how are you making sense of this?
At some point in time, Aditya, because you have more technological competence than me, we should look at the historical precedents for gold moving up in conjunction with the US dollar and gold moving up in conjunction with interest rates. I suspect, but I don't have the data at my hand, that both of those circumstances is extremely bullish. I think that gold moving up with equities markets moving up is much more coincident in the sense that the market forces that are causing gold to move up are very much foreign central banks. And the participation, both institutional and retail, with regards to equities markets is very different. And so I don't think that there's any particular correlation. Yes, there is a very, 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 very small subset of retail buyers who are in gold for speculative purposes. But I would suggest that subset of buyers has probably disintermediated to some degree to technology stocks or to cryptocurrencies. I suspect that the move in gold and equities isn't merely correlated with easy money or liquidity, but is much more coincident than correlation. But I suspect that we will find, if we look back on today, 10 years from now, that the moving up of gold in conjunction with the increase in interest rates, and if we look at gold on a global basis moving up in conjunction with the US dollar, that what we see is something substantially more profound. The recent, in historical senses, aberration around the yield curve is, I think, particularly instructive. The Fed has been fairly aggressive in lowering the Fed funds rate and lowering the near-term ascribed interest rate. At the same time that the institution's costs of funds have lowered, the rent on long-term money has increased, which is to say the rates on the 10-year, the 20-year, the 30-year have gone up at the same time that the Fed is trying to manipulate the near-term rate lower. What that appears to be telling me is that the buyers of long-term debt are much more concerned about inflation than they are about their short-term costs of funds. The market has begun to reassert control over the long end of the yield curve. What I think that means is that the market is seeing the same thing in terms of incipient inflation that I am.
As an investor in the miners, I know that you pay a lot of attention to the net asset value of a mining company when you invest in one. One of the key inputs into that calculation is the price of gold that you use.
Yep.
Given that we are now breaching gold price levels that haven't really existed in the past, how do you think about the net asset value calculation for your own investments from an upside perspective?
Well, I think that gold companies, if you value them at $2,500 gold, are reasonably priced. Not cheap, but reasonably priced. I would hasten to point out that in 50 years of investing in gold stocks have never been cheap. There is always optionality priced into them. At present, optionality isn't priced into them. And I think the reasons for this are instructive. In the first instance, the strength in gold comes from foreign central banks, who are gold buyers, not stock buyers. The buyers, the market forces that have driven the gold price up have had no impact on the gold equities at all. So let's ascribe part of the delta and part of the valuation issue to the fact that, at least at present, these are two different markets, related markets to be sure, but different markets. A second problem with regard to the gold equities is something that goes to the market's definition of valuation rather than to mine, is the fact that the generalist investor is absolutely absent the gold space. The generalist investor has found more or less continually that there are other more interesting sectors. For the generalist investor, I suspect that many of them have difficulty spelling the word gold. And the gold trade is certainly lonely. And to the extent that an investor's estimate of net asset value involves some degree of speculation as to what net asset value parameters the rest of the market would think is appropriate, most generalist investors don't even bother themselves with the equation. Now, there's plenty of money left in the gold investors' coffers, too, and one wonders about their reticence to be in the gold space. I suggest in that circumstance that investors' expectations with regards to valuation are tempered by the experience that investors had with corporate decisions that were made in the period 2000 to 2010. I've had this discussion very recently with a couple of veteran investors. To refresh our listeners' memories, Aditya, I know you're aware of this from having suffered through this dialogue before. In the period 2000 to 2010, where the gold price increased sevenfold, the free cash flow per share on the Philadelphia Gold and Silver Stock Index actually fell. And the expectation is that the management acumen of the mining sector is not consistent with the best and the brightest in humankind. Part of a net present value calculation in extractive industries, Aditya, and you'll remember this from the oil business, is something called the recycle ratio. In other words, what do you expect the industry to be able to do 3 or 4 years from now with the revenue, with the margin that they generate today? If you apply the recycle ratio that the market enjoyed in the decade 2000 to 2010, what you expect them to do is destroy a substantial amount of value with the money that they generate today.
I sent you a chart of the price performance of the 5 largest companies in the gold sector relative to the price of gold. This includes both producers and royalty companies. I was interested in your views on why large cap market beta is not working in the current precious metals market. Do you see anything fundamentally different in either the management of these companies, the quality of their assets, or their valuations today?
I would suggest that Barrick and Newmont have had and continue to have identifiable problems. Uh, Franco, I would suggest, is premium priced, which is to say it's selling at a substantial premium to NAV by any method of calculation, either book, which I think is a very flawed measure for these kind of companies, or in fact, the net present value of future cash flows from existing identified reserves and resources. I would point out to you, however, that Franco-Nevada's asset base, after having produced for 35 years, much of it, has the same net asset value today as it had 35 years ago, which is to say that I suspect that the tail in Franco-Nevada, which is to say the free cash flow after the discounting period has disappeared. So in the case of Franco, Wheaton, and Agnico, while these companies are not attractive on a NAV basis, they are attractive and continue to be attractive from my point of view on a performance basis. In the case of Franco and Wheaton, I personally am willing to ascribe a premium to NAV for those companies because of their traditional history of intelligent capital deployment, because of their relatively constrained G&A, relative to their free cash flow, but much more importantly, because I think at least on the streaming side of the business, that there is potential for an awful lot of growth ahead of them, and growth that will only accrue to companies with very large balance sheets that have the opportunity to take advantage of that growth. So I think that there will be financing opportunities, particularly in the copper business, to contribute billions of dollars to the capital balances for construction by buying streams on gold revenues from copper-centric deposits. The market values, rightly, I believe, free cash flow from gold higher than they value free cash flow from copper. The copper business over the next 5 years needs to spend a minimum of $50 billion in new project construction expenditures. And I suspect that as much as 10% of this will come from royalty and streaming activities. The capital markets believe that the streaming companies are both too large to grow from here. And I would suggest to you that their largest transactions are ahead of them rather than behind them. And for that reason, I'm willing to assign premiums to net asset value because I believe that the recycle ratio that they can generate will compensate me for that risk.
Another group of miners that I find are very difficult to invest in or speculate in without paying a premium are the silver miners.
Absolutely true. Absolutely true. In the silver miners, you have a couple of challenges. The first is that they are almost always in the worst half on the cost curve. The reason for that is that as much as 80% of new mine supply worldwide, sometimes more, comes as a byproduct from copper, lead, or zinc production. And one could argue that, as an example, Rio Tinto's production costs in silver are zero because it's produced as a byproduct of copper mining. That's a challenge for silver miners. What you see priced into the silver market, the silver equities market, the pure silver equities market, is almost always, despite people's best attempts to explain it away, a premium that you pay for optionality. And Aditya, I've tried to explain to myself and to many others for 50 years the nature and structure of the silver market, and I've been unable to do it. When I try to forecast or evolve a tool to forecast silver supply, I never have an appropriate handle on recycling. I never have an appropriate handle looking 4 or 5 years out at what the zinc price will be, the lead price will be, or the copper price will be. And that's important because they determine how much byproduct silver production I will enjoy. Further, on the supply side, it needs to be noted that despite broad spread industrial uses of silver, the investment attributes of silver mean that an awful lot of silver has been hoarded and in many cases hidden. And that silver tends to come out when things that you wouldn't necessarily think are relevant become relevant. And demand isn't easy to forecast either. You can look at silver demand in applications like reflective properties, which is to say solar, or the increasing demand around health, water purification as a germicide, but you miss investment demand. And investment demand is very much built around sentiment. I'm horrible at anticipating sentiment, but I too am willing to speculate in the silver market because of my personal experience with the performance of silver stocks in past precious metals bull markets. And in that case, I'm not a value investor. In that particular case, I'm a greedy and larcenous trader.
Well,
I would also ask you in terms of that, where you and I had a discussion, maybe only a year ago, where I described the silver juniors as a coiled spring. It wasn't because that I thought that there was going to be any explosion in the silver price. And it wasn't because I thought that there were going to be explosive discoveries in the silver space. It was because there was no speculative upside attached to the sector at all. The silver stocks were absolutely hated. And in that circumstance, I thought that if we merely got reversion to mean in terms of the public's appetite for silver stocks, that we would get a nice bounce. And in fact, we got that bounce. So I no longer regard them as coiled springs. But I do note, and I'll repeat, that in my experience, precious metals bull markets are led by gold. And if the precious metals bull market is of sufficient duration and momentum, that as the generalist investor buys into the narrative and comes into the space, first silver and then silver stocks lead and outperform. And I absolutely positively have learned in my career that the population of reasonable quality silver stocks, the market capitalization is not a large enough silo to handle the influx of funds that come into the space. Note that this is not a discussion of valuation.
I sent you this chart in an email yesterday. The same conditions about using CPI to adjust it for inflation probably applies to the silver chart as well. Right. But one of the things that is evident in this chart is that silver has only touched the $30 mark on an inflation adjusted basis 4 or 5 times in the last 50 years. In 2 of those cases, it went significantly higher, but in the other 3 cases, it crashed. So the same question I asked you with regards to gold, flirting levels above which it hasn't existed, is that a point of concern for you?
It's not a point of concern for at least 3 reasons. The first thing, as you suggest, is that the metric in the chart is flawed. The CPI is a joke. It's widely believed to be true, and that, I think, presents an opportunity. Soros famously said, find a broadly held perception that's wrong and bet against it. And inflation, measured by the CPI, is a broadly believed statistic that I think is completely wrong, and I'm betting against it. The second is my observation, and I can't tell you why. I can just tell you that historically, a precious metals bull market, when they occur, is led by gold, not by silver. And I expect that silver's response, if any, will be delayed, that you will need to see continued outperformance by gold, which, of course, by the way, you've seen. If you measure the relative performance of both in the period 2000 to 2025, you will see that gold has been a fairly consistent performer, and silver has been, at best, a spotty performer. I am willing to participate in the silver space. I'm almost tempted to say irrationally, because of my expectation of an irrational response. And I think that that's a contingency we're speculating on with money that I can afford to speculate with.
I find it interesting that you've said this a few times on this call that if we get a precious metals bull market, the price of gold is at 2,700 and the price of silver is at 30. You still believe that what we're seeing right now is not a real precious metals bull market?
That's correct. I believe that gold has merely kept pace with inflation in the period 2000 to 2025, which is, of course, what it's designed to do. Not designed to do, that's the wrong phrase, what it is believed to do. When people ask me when the gold price is going to move, I normally smugly smile and say, well, the gold move is going to begin in the year 2000, 25 years ago. It's moved at 8% compounded since. Not dissimilar to my view of the rate of real inflation. But I believe that expectations of inflation in the future are understated. And I believe, too, that they're inescapable. Uh, we've talked about the reasons before, but there will probably be people listening to this call who haven't listened to previous calls. So if those people will allow me to, I'll stumble through them. The first is that I think the United States, the US dollar will continue to outperform most world currencies. So while the US dollar will be strong relative to other fiat currencies, I think an internal look at the US dollar suggests that US dollar savers will experience deteriorating purchasing power by holding the dollar, even if they hold the dollar in interest generating accounts. I note that the on balance sheet liabilities of the US government exceed $36 trillion. I note that that's a 20 or 25% premium to GDP. That's the first problem. The second problem is that the on balance sheet deficits this year should handily exceed $2 trillion. Interesting when you look at the fact that federal revenues are $5 trillion. More concerning to me, Aditya, is that the off balance sheet liabilities of the US government, including Medicare, Medicaid, Social Security, federal government pensions, all those things, are estimated by the US government to be at $100 trillion. And that number, too, that's a net present value number, by the way, not a nominal number. And that number, too, is increasing on an annual basis, according to our government, by between $2 and $3 trillion a year. That arithmetic becomes alarming when you look at the increase in on and off balance sheet liabilities at the federal level at $5 trillion a year. And you understand that in 2024, pardon me, gross federal revenues before any expenditures were $5 trillion, which is to say that the debt is growing as fast as gross revenues are. It becomes more problematic, and these would be interesting charts for you to originate, Aditya. It becomes more problematic when you look at the fact that the Internal Revenue Service estimates the net private wealth of American citizens at $141 trillion. Now, understand that this doesn't include the value of federal assets. I don't think that the bondholders will be able to foreclose, so I don't include those. But if you look at the fact that the net private wealth of Americans is $141 trillion, and you look at the fact that the net obligations of the US government, not including federal, state, not including state, local, individual, or corporate debt, is $130 trillion, that leaves an $11 trillion margin. And that number is very scary when you look at the fact that the on and off balance sheet liabilities of the government is increasing at $5 trillion a year. It's not too far before those lines cross. What do we do about that? Do we have an honest default where the government says to bondholders, too bad, so sad, no money, no payments, strong letter to follow? And where we say to entitlements beneficiaries, yes, we realize that you paid into these accounts all your working life, but there's no money to pay you. Do we have an honest default? Or, as I believe more likely, we have a dishonest default. We honor over time the nominal value of our obligations by inflating away the net present value, the purchasing power of those obligations. We had this choice, Aditya, in the decade of the 70s, where we fought the war on guns, the war in Vietnam, the guns aspect, we lost. We fought the war on poverty, the butter aspect, we lost. And we couldn't raise taxes because the nominal tax rate, the marginal tax rate was already at 70%. What we did in the period 1970 to 1980 is, according to the Office of Management and Budget, we reduced the purchasing power of the US dollar over 10 years by more than 75%. So that the nominal valuation of, say, a $500 a month Social Security payment was honored, but that Social Security payment only bought $125 or $140 worth of goods and services. I think past is prologue in this circumstance. It's not coincidental that during the period of time when the purchasing power of the US dollar fell by 75%, that the gold price tripled. Now, admittedly, the first part of that increase of the gold price, the move from $35 to $100, can probably be ascribed, to taking away the federal cap on the gold price, allowing the price to move. But I would suggest to you that the move from $100 to $850 was due, first of all, to the deterioration of the purchasing power of the US dollar, and then to an investor contagion, as the increase in gold price justified the narrative around the reasons to own gold. And in that circumstance, I believe past is prologue. I believe that we are going to inflate away a lot of the purchasing power of the US dollar. And I think eventually that realization will come to be important to American and savers. And it wouldn't surprise me, although I can't guarantee it, that the fondness for the gold narrative will become a mania around the gold narrative in the same way that it became a mania in 1980 and 1981, even as the cure was in sight.
There was a funny thing that I think Howard Marks said, is that most of the time, the end of the world doesn't happen.
Correct. We will get through this, Aditya. We will absolutely get through this. We have a wonderful culture that accepts the best and the brightest from around the world, yourself included. That's wonderful. We have a country where 5 or 6 pimply faced kids can commandeer a garage and out pops Google or out pops Apple. The truth is, Aditya, throughout our history, and this will be no different, our individual brilliance, our individual tenacity, our individual problem solving will fund our collective stupidity. I think we have a reckoning between here and there. And I think that investors and savers need to think about how they get through the next decade.